Good evening, ladies and gentlemen. Thank you very much for coming and welcome. Tonight, we would like to deliver for you a really positive outlook on the Renters' Rights Bill, the key changes that they're going to bring, talk about mitigating risk as a landlord, talk about efficiency, tax efficiency in particular as a landlord, and also have a look at future legislative change in the lettings industry. We are going to kick off the running order this evening. I'll start looking at the Renters' Rights Bill. Matthew will continue on looking at the Renters' Rights Bill, so between us we'll cover that in the first half of the seminar. And then after that I'll come in and talk about mitigating risk. Then Sophia will talk about tax efficiencies, and then I'll finish off with a little bit on future legislative change for you to consider. What I can start by saying is that the Renters' Rights Bill went through the House of Commons at 2:45 this afternoon. So we now know exactly what the bill is. It only has to be rubber stamped by King Charles to get royal assent and become the Renters' Rights Act. So everything we talk about this evening, hot off the press, is exactly how the law will be. So without further ado, all tenancies will be assured tenancies. So this means that they will be periodic. So you cannot have fixed terms anymore. So no longer can we have a 12-month tenancy or a 2-year tenancy. They will all be rolling month-by-month basis tenancies. There's no official minimum term to these tenancies, but a tenant can give 2 months' notice at any point. So theoretically, a tenant could move in on day one, give you 2 months' notice, and the tenancy could last for 2 months. So that's quite a big change. We as agents will be doing everything we can to vet the tenants, meet the tenants, and ensure that we do everything we can to get a tenant who is going to be in for the long term rather than the short term. No refunds. If they move out, and that's it. So the onus has got to be on selecting the right tenants you think will be in for the long term so they don't move out in the short term. Ban on competitive bidding. So as landlords and us as agents, we cannot solicit, ask for or encourage any form of competitive bidding when you are marketing a property for rent. You cannot accept an offer above the marketing price of the property. If you market it at £2,000 a month, you cannot accept an offer in excess of that. So best way to overcome that is speak to your agent and work out where exactly you set the price, and maybe just factor in a little bit of wiggle room so you've got that space. And you can't get around it by saying price on application. You can't get around it by saying price range. You must quote an exact figure for a market rent. There are fines of up to £7,000 if you get this wrong. Once again, don't let this shock you too much, because we can always set a rent at the right level and make sure we get the right tenants at the market rent. Upfront rent payments. We can no longer take 6 months' rent up front. We can no longer take a year's rent up front. You're only legally required to take 1 month's rent up front. This could cause some issues with regards to expats moving back to the country who won't go through normal referencing, could cause some issues for someone who might have recently gone self-employed, does not have accounts to get through referencing. So this is just something we've got to overcome. But it does allow guarantors. So quite simply, I think we'll be relying more on guarantors than we will under the current system to make sure that rent can be paid. And actually, even if someone pays 6 months up front, they're in your property, and after 6 months and that money's gone, they're still responsible for the rent going forward. So once again, please don't be overly concerned by that. Rent increases, so I'm quite a pace here because we've got a lot to cover, can only be asked for by serving a Section 13 notice. So that is the only mechanism for asking for a rent increase. You must give the tenant 2 months' notice of that increase, and you can only do that once per annum. And it must align with market rent. So if your current contracts have got clauses in it saying RPI increases, CPI increases, or any form of the rent will go up year by year by year, as and when this Act becomes, those clauses will be overwritten, and you can only raise the rent to market rent. If the tenant is not happy with the market rent, they have the right to take that to a tribunal to challenge it. and then the tribunal's verdict will be final and binding. This is one which has been slightly controversial, is pets in tenancies. And I know as landlords it is a worry because there are fear stories about pets causing quite significant damage. Now, once a tenant is in a property, a tenant will have the legal right to request a pet. And you as a landlord will have to give a reasonable ground to deny that request. Now, the problem we've got is the UK system is based on case law. And until cases start going through the tribunals, we're not going to have a huge amount of guidance on what might be deemed reasonable and might not be deemed reasonable. What could be reasonable if you're in a flat and the head lease says no pets? That's a reasonable clause because it's bound upon you. Whether it might be reasonable that we don't know exactly what it will or won't be, but what we can do is ask the tenant lots of questions. So we can ask if the dog's been vaccinated, if the dogs or pets have got flea issues or any vet issues that might cause problems with the property. You can ask these questions and then make a decision. But what they have made completely clear is that potential risk of damage is an unreasonable reply. So risk of damage cannot be used as a quid pro quo. In law, as a landlord, if the tenant is in, you will not have the ability, unless you have a reasonable ground, to refuse a pet. And also, originally they were looking about insisting that the tenants had a insurance policy. That has not made the Act. The Lords suggested an increased deposit of 3 weeks. The Commons have removed it, so that's not in the Act either. So it literally is 5 or 6 weeks max deposit is what you can take depending on the value of the property, and no further, and there's no other way that one can claim against that. So on to the next slide. This is the Equalities Act. This has been in force since 2010. These are the reasons or how we cannot discriminate against potential tenants. They're all here listed up on the board. The Renters' Rights Bill is separate to the Equality Act, but it adds 2 clauses. One, we cannot discriminate against families with children. And number 2, we can't discriminate against anyone with receiving benefits, which includes housing allowance recipients as well. So they cannot any longer be refused. So gone are the days where you'll see no DHSS on your tenancies. But coming to your point, you can clearly see that saying no pets in advertising is not prohibited. So you could still market your property as no pets, and you could still select a tenant based on them not having pets. But if they wanted a pet mid-tenancy, then you have to have a reasonable ground to decline it. So that's the first half of the Renters' Rights Bill. I'm now going to hand over to Matthew, and he will run through the next half.
Just a brief introduction. I'm Matthew Cotton. I'm a solicitor and mediator at Kendall & Davies. I, together with Richard Davies, head up the civil and commercial disputes team. A lot of you here this evening, I was saying to my colleague there, to Sophia, that will be fearing the changes with legislation. But rest assured that you're the good landlords, because the reason you're here is to learn about the changes. One of the main changes with the legislation is to drive out unscrupulous landlords, to drive up standards for the rental sector. So there's been understandably a lot of concern about the Renters' Right Bill. There's a lot of tenants who are out there desperate for change to increase the standards of which they're living. But also landlords are fearing change, especially with the removal of Section 21 non-fault evictions. One of the main objections of my presentation today is to build on what Tom's already said to you about a broad outline of the changes in legislation, dispel some of those myths and give you some practical advice on how to deal with some of those changes. Just to give you a bit of background and some statistics, it's been a long aim of successive governments about changing the private rented sector. In Wales, since 2022, there has been an act which has brought in fitness for human habitation, which isn't applicable to homes in England. So levelling up that standard across the board is one of those aims. The statistics within the 21-22 period, and the importance of this will become clear, is that nearly a quarter of private rented homes in that period failed the decent homes standard. So they weren't fit to live in, and yet we were putting tenants in them. Nearly 1/5 of those homes were found to have Category 1 hazards, which have a serious and an immediate risk to health and safety. And over a quarter of them, over a quarter of renters were unable to heat their homes. It's of particular note that these statistics are broadly similar to those in the 22-23 English Housing Survey. The reason behind this is because the white paper to the Renters' Rights Bill was in 21-22. That was when it was published, and the bill was introduced in the 22-23 parliamentary sessions. So this was in the background whilst they were bringing the bill into force, in the background. With this as a backdrop, statistically, it's clear to see why there was decisive action was needed. And you can see, hopefully at the back of the room, the study in 2023 showed that tenants who complained were over 2.5 times more likely to be evicted. So, building on some of the changes that Tom's already spoken about, there are some regulatory changes. And this is to make sure that there are a maintaining of standards throughout, so that all landlords are held to the same standard. AWOB's law, or the Decent Home Standards, will now apply to the private rented sector. At the moment, it only applies to the public rented sector. The rent repayment orders will be extended, and local councils will have a duty that's been introduced, and enforcement powers. There will be a new private rented sector database and ombudsman that's to be introduced. So landlords must register properties on the new database to support compliance. And there must be a right to redress. What you've all heard about in the media, there's been a ban on the Section 21 non-fault evictions. We'll get to that later on. I'm sure that's on most of your mind. And lastly, the court process and the alternatives to litigation. Something to bear in mind because of the inability to now evict tenants on a non-fault basis. So I'll cover that briefly to give you some alternatives. So AWOB's law, for those who don't know about it, is the application of the Decent Home Standards into rented properties. It was brought about when there was a death of a toddler in 2020 from prolonged exposure to damp and mould in social housing accommodation. Decent Home Standard merely makes sure that the property is habitable. That's all it is. It has 4 criteria: that it is safe and free from serious hazards, that it's in reasonable repair, have modern facilities and services, and provide adequate heating and insulation. Everything that we would expect in our own homes, so it's not unusual to expect that in the tenant's home. So following the AWOB's case in 2020, there was a Social Housing Act of 2023, which brought it into place for social housing. But until now, we haven't seen it in the private rented sector. So the bill, which will soon be receive royal assent, hopefully, will seek to align those standards across England and Wales, and across the public and the private rented sector. AWOB's law holds at the moment social, but soon to be private, landlords accountable for addressing complaints of damp and mould. All rented homes will have to meet the Decent Home Standard, and there will be a time frame for dealing with those hazards. So, just to give a bit of background, a significant hazard is one that presents a significant risk of harm to the health or safety of a tenant. Once a complaint has been raised by a tenant, you've got 10 working days to assess if there's an emergency, such as a gas leak that needs instant attention, or a serious risk of harm, such as mould that needs prioritising. You need to share those findings with the tenant within 3 working days of the investigation concluding. then you need to start work on those emergency or serious risk of harm within 5 days or within 12 weeks if the works are complex. And you need to temporarily move out the tenant if the home can't be made safe for them. There's no defence to the Decent Home Standard. There are potentially exemptions if upgrades aren't reasonable for the property, but you have to prove that you've used reasonable efforts to ascertain that's the case. So it might be that it's a particular type of property that those standards can't apply to. Or there might be avenues for flexibility, such as you've purchased a property which doesn't comply, and the local authority will give you time to remedy. So it's not a defence per se, but they will allow you time to rectify. Vulnerability can escalate the risk from minor to significant to an emergency standard. And those vulnerabilities can be children under 5, as I mentioned, AWAB's law comes from a toddler, elderly adults, people with respiratory conditions, pregnant individuals, mobility or sensory impairments, or long-term health conditions. If any of those apply, the severity risk will increase and you'll need to take more urgent action. So that moves us neatly onto enforcement. So I mentioned before about rent repayment orders. You may or may not have heard about this. Rent repayment orders are where a landlord can be ordered to repay rent if they've committed a listed offence. So if they've executed violence or harassment to the tenant, if they failed to comply with improvement order from the local authority, if they've tried illegal eviction. If that's the case, the tenant or the local authority can apply to the first tier tribunal for a rent repayment order. The Renters' Rights Bill is extending the list of offences into discrimination, which Tom just spoke about earlier on, discrimination under the Equalities Act. Knowingly or recklessly misusing a possession ground. So that's to try and stop revenge evictions. False information given to or failure to register on the database, which I'll get to later on. Breach of a restriction that's imposed, or breach of the landlord redress scheme regulations. And the bill is also extending rent repayment orders to superior landlords and company directors, and that's to tackle criminal enterprises. As I said from the outset, it's to deal with levelling up the playing field in the rental sector. Tom touched on the maximum penalty, and I'll deal with this. For first and minor non-compliance, you could look at a civil penalty of £7,000. If you've got serious or repeat non-compliance, you could look at a penalty of £40,000 or criminal prosecution. It's a deterrent against non-compliance and ensuring that standards are maintained. So it's only a concern if there's landlords who are not complying with the rules. The Renters' Right Bill will introduce a new duty on local authorities to take enforcement, and it will enhance their enforcement powers. The government is planning on introducing a national framework so that local authorities can speak to each other to stop the criminal gangs, to stop non-compliance throughout the whole nation. That's being explored at the moment. I'll come on to the difficulties of that later on, which I think may have a practical impact. I mentioned the database and the ombudsman that are coming into place. The bill will require landlords to register on a new private rented sector database before they can advertise or let their property, either personally or through an agent. This is supposed to be a one-stop shop, so it's supposed to give tenants confidence about who they're renting from and landlords given confidence about their rights, so they can go to a database, be informed about the rights and obligations. If you fail to register, that's the £7,000 I mentioned. If you give false information, that's £40,000 fine and criminal prosecution. It ensures a benchmark for rental properties, and the way in which they do that is to back up with teeth the compliance with penalties and criminal prosecution. The Ombudsman is there to offer a fair, impartial and binding resolution for tenants, and will have the powers to compel landlords to issue an apology, provide information, take remedial action, or pay compensation. All private sector landlords will need to join, whether or not they're using a lettings agent. And as I said before, local councils will be able to act against landlords who fail to join, or agents who market and manage properties where the landlord isn't registered. From my profession, this might be a case of déjà vu, where we've seen the government and the Ministry of Justice trying to bring in an online court. And COVID sped up online court processes, but we've still yet to see the online court. So in my opinion, the effective enforcement of these provisions that we're talking about today will require more clarity from the government as time goes by, and further resourcing. And that will be the sticking point, I think, a significant hurdle in itself. This is the section that you've been waiting for. The removal of non-fault notices. So for those, just a sort of quick 101, Section 21 of the Housing Act 1988 is non-fault evictions. You can do it at the end of a fixed term or by way of a break notice after 4 months. Section 8 of the Housing Act is a fault. You have to have a fault eviction where you have to have specific grounds. The bill removes Section 21, so you only have to you must have specific grounds to evict a tenant. As a form of balance, the bill extends the Section 8 grounds. So where landlords need to sell the property, or they need it for personal or family use, or where there's persistent rent arrears or antisocial behaviour. But to stop recurrent evictions, misuse of the grounds, as I mentioned earlier on, where you could look at a £7,000 fine, £40,000 fine. Landlords aren't permitted to move back in or sell their property in the first 12 months after renting it out, unless it's sold to another landlord who's going to take over that property and continue renting to the tenant. However, tenants will be able to serve their notice, 2 months' notice within that 12-month period. Coupled with this, we've got new grounds for HMOs, for students, because there's a more turnover for students. There will be an increase of threshold of rent arrears for mandatory possession. So you now can't evict a tenant for 2 months' rent arrears. It will go up to 3. And the notice period that you have to give them will go from 2 weeks to 4 weeks. And the purpose behind this is to try and give the tenant enough time to try and repay the rent arrears. Balance with that is to stop unsustainable costs for the landlord. On the point of costs, and again within my profession, I regularly see landlords, and I'm instructed by landlords to seek possession for properties. And those costs can get away with themselves because the costs within the civil procedure rules are fixed. If you are able to recover possession of a property and you're ordered by the court that you can have possession of the property, you will only recover a fraction of the cost that you've incurred. So around about £100. You think of an hourly rate of a solicitor, it's going to be a lot more than that. It takes more than an hour to issue the claim, go to the court, attend the hearing, you're already out of pocket. So the idea behind this is to try and level the playing field. It gives the tenant longer to repay. It gives the landlord that ability to avoid those costs if they can do. The timescales of getting it to court can be in excess of a year. So you're out of pocket and you're not renting it out to another tenant for a whole year. So at the moment, it's unsustainable for landlords. And the bill tries to address this. Drawing on that, the alternatives to litigation include mediation. The Ministry of Justice will no doubt, separately to government, the Ministry of Justice will no doubt be wincing at the idea of more possession claims. You can't issue an accelerated possession claim which takes no hearing. You have to go through the Section 8 process, so you need a court hearing. There's already a backlog in the courts. What are we going to do about it? The judges will be overwhelmed by the amount of paperwork. So the Law Society are calling on the government to outline how it intends to manage the increased court caseload and what additional resourcing will be put in place to deal with those backlogs that are already there. Yet to hear from the government. So more clarity is needed on the efficient court process that we've been offered, we've been promised. Mediation and other forms of alternative dispute resolution are a method of dealing with eviction and problem tenants. We have a pre-action protocol, steps you have to go through before you issue a claim for social housing. We haven't yet got one for private rented sector. My prediction is that we'll get that in due course. Steps you have to go through, including trying mediation. The Association of Residential Lettings Agents, ALA, offers a mediation service, and ADR, including mediation, is recommended by the courts. You can't mandate it, it's a voluntary process. But the courts and the civil procedure rules suggest and guide people to take those steps if they can do. So in conclusion, at first glance, the bill itself might be viewed with scepticism and fear. That's why you're all here today, to learn more about it, because it's a trouble on your mind. But it should be welcomed with the proposed changes that we've got coming in to the private rental sector. One of its aims is to increase the living standards for tenants and drive out unscrupulous landlords. So I wouldn't be surprised if that helped bolster the private rented sector in itself, when there's more security and more peace of mind for tenants who are entering into it. By cleaning up the sector, it results in more confidence from tenants, all landlords being held accountable for the same standards that apply in their own home, such as mould. No fear of eviction from your own home at the drop of a hat. When's it likely to come into force? Well, at the moment, present predictions are end of this year, start of next. At the moment, as a backdrop, we've got the UK government falling short in its housing policy. And also, we've got challenges with the economy. So my prediction over the course of the different changes that we've got coming in is a phased approach. So the database, the ombudsman, the national framework, as I say, all those require testing and further funding. So my prediction would be a staged approach. So key changes like the removal of Section 21 coming ahead of those regulatory powers and services. The advice is preparation is the key. You've got professionals here to guide you through, ranging from accountants to lettings agents to lawyers. Use us as best you can to navigate through the changes in the legislation. And just a bit of details about us. Kendall Davies at all 5 offices.
Just going to touch on investment risk. And what a lot of what Matthew's saying, particularly with the court process, really is last resort. When you serve a Section 8 notice, the vast majority of the time, or a Section 21, the tenant will leave. So we are only talking in a tiny fraction of times that you have to use the court process. Vast majority of the time, the tenant will leave if served a notice. Now, any investment, and you've got to, as a landlord, you've got to look at it as an investment. Being a landlord is an investment. And with any investment, be it stocks or shares, whatever it may be, there is risk. And there are ways of mitigating that risk. And actually, being a landlord, I mean, it's not as if you invest in a company and that company can disappear and your money can go to nothing. I mean, your property values are not going to drop through the floor, so they may dip a bit. So actually being a landlord across the broad section of investments is not a bad idea. And quite often you look at landlords and they look at the straight yield, but there's 2 types of growth from a landlord. Number 1 is the yield from the rental income, and number 2 is the capital growth of the property. So it's actually a pretty wise investment, so please don't let us put you off this evening. Ways that you can mitigate that risk. Number 1, find an agent that is highly qualified, highly regulated, local, got a reputation. We will smooth the way. And actually one of the questions that came up in advance was landlord's insurance. Is this a wise idea? I'm a landlord. I've got one property in my portfolio. I've never actually insured it. You'll probably think I'm slightly mad, but I will actually now start insuring it. So it just gives you a bit of an idea. So I cannot advise on landlord's insurance because I'm not an insurance broker and I do not have insurance qualifications. However, what I can do and what we are doing as a business is we are packaging, and we have gone to the market and looked at the options available for landlord's insurance. We're bulk buying a policy and then we're offering it back as a service. So this is what we're going to be offering to clients of ours. So if this is something you're interested in, you're very welcome to come and speak to us about. But also to give you a guide that if you're out there shopping for your own policy, what I would look for within a policy. So number one is 100% of the rent is paid. So if the tenant doesn't pay rent right the way through to you get vacant possessions back, the rent is paid. Full legal cover. All the legal expenses are completely covered, so you're not out of pocket. And also, as long as we report it in enough time, nil excess. So there's no excess payment on that policy. And on top of that, once you've got your vacant possession back, this policy will also pay 90% of your rent for up to 6 weeks while you relet your property. It will go and add £1,000 on top of the tenant's deposit. So if there is pet damage, for example, you claim the full deposit, this will pay out an extra £1,000 towards any additional rent arrears or deposit, or damage deposits. If the tenant doesn't start paying the higher rent straight away, this policy will kick in and pay the uplift until the tribunal hearing. As we can't take rent more than a month in advance, you cannot take your first rent payment until the day of move-in. So there is a risk that contractually you've got to hand over the property, but that rent might not be forthcoming. It's a very small risk, but there is a risk. So this policy within 5 days will refund your first month's rent if the tenant never pays it. And a small add-on, it's not actually a lot of money in this section, but it will also, if you've given notice to move back into the property yourself as a landlord, it will give you up to 90 days alternative accommodation and storage. And we'll be offering that service from £1.61 per day. The higher the rent, the higher the premium. But if you're looking for a policy and you want to go search and direct yourself, I'd advise that those are the things you look for. In us choosing this policy, as we know with all insurance, one of the most important things is it actually pays out. And insurance companies are great at doing their best to wriggle. And at the end of the day, one of the main reasons I've looked at this is a contact of mine runs a business with a portfolio of lettings properties of over 1,000. And she's been using this policy for some time now. And she's said to me that this policy pays out. Every time I've needed it for a landlord, it has paid. And that for me is worth its weight. So I can't sell insurance, so we've gone and bought the bulk policy and then we can sell it on as a service. Or you can go and pick your own. It's completely up to you. If it's with us, we do all the admin, we do all the renewals, we do all the claims and do all that. If you want to go direct, then obviously you'll have to do that yourself. But we obviously add a bit in because we're doing all the admin. So this is just a landlord's insurance policy. So whether it's listed or unlisted, yes, it's to cover you as a landlord. So the building being listed is irrelevant to this. So yes, it will cover. It's per property, yeah, and that's for property up to £1,000 per calendar month. As soon as the rent starts to go higher, the premium amount will go higher. And actually, to be honest, landlord's insurance escalates really rapidly the higher the rents. You start to go above £4,000 or £5,000 per month. Actually, the policy really ratchets up, so it is actually relatively expensive. For anything under £3,000 a month, it's what I would say affordable, or quite happily affordable. So that's how you can mitigate risk. So if we're worried, you can mitigate an awful lot of risk with this policy. And it's a really interesting way, or something interesting for you to look at. Now, looking at saving more money, I'm going to hand you over to Sophia to look at some ways that we can be efficient in the way that we buy, set up and run our investments.
Thank you, Tom. as Tom said earlier, my name's Sophia Maynell. I'm one of the directors at Taylor Barley Tomlin, based here in Morton Marsh. We've been serving the Cotswolds for over 30 years, not myself personally, but our founder, Asad Noorani, who is actually on holiday this evening, so isn't here, so has left me to deal with this kindly. But I do have two of my fellow directors here, Rory and Ewan, and I know they'd be delighted to talk to you afterwards if there's anything you'd like to discuss with them or questions. Now, tax is a bit of a minefield. I'm not going to attempt to try and teach you tax in an evening, given I've only got about 15 to 20 minutes. I think the key thing that is important to acknowledge is actually, as landlords, you're facing a lot of change. There's lots of changes in legislation to navigate, and tax is no different. As I stand here this evening, we are waiting for the next budget to come along. I'm sure you will have seen some of the speculation in the press. Of course, none of us have a crystal ball, so until we actually get the announcements on the 26th of November, things I say tonight could be completely changed in 4 weeks' time. That's the joy of tax. But also that's why it's really important that you do engage with professionals, because what you might set up today might not work in 5 or 10 years' time. And we do often see people who arrive on our doorstep having not revisited their arrangements in a number of years and realise that actually what they'd set up or thought they were setting out to achieve at the outset has not achieved their objectives. So I think the key thing that we do know is that the government have said they're not going to raise taxes on working people. And what they mean by that is they're saying, actually, if you've got assets or other wealth, then we may well raise the tax rates on that. So, we may see increases on capital gains tax. It was a surprise that it didn't actually go. It's been long speculated that we will see a shift in capital gains tax rates. And it was a surprise that, in fact, they actually came down slightly from the 28 to the 24 in the last budget. And again, we're hearing rumours around wealth tax on higher value properties from council tax perspective, but also potentially threatening the Prime President's relief that in the UK we've always had on your main home, that any gain on that has been to date CGT free. But as I say, until we get to that stage, who knows? The other thing that is really important to acknowledge is that HMRC is, part of the significant gap that the government has to close. HMRC has seen significant investment in resource. And what that means is we see a lot more compliance type activity. What's compliance activity? That's those lovely letters you get through the front door on the brown paper with the HMRC symbol on the outside. They have been running a Let Property campaign for the last 10 years or so, and through that they have raised over 370 million in lost taxes. So this is actually a really successful thing for them. And you might be sitting here in the room thinking, well, I don't understand what that would be, but that's because there are landlords, unlike yourselves, I'm sure, who are not declaring their taxes properly. Either they're hoping to fly under the radar, or it could be that they're not actually realising how and what they should be deducting against their rental profits, and so making mistakes in returns. So it has been a fairly lucrative initiative for them to ramp up their compliance activity. I think I'm going to look at this evening just a very quick overview of the different types of ownership structures in which you might own a property portfolio. But I think the important thing to realise is that there isn't a magic bullet. There is no right answer. It is going to come down to what are your long-term objectives and what you're seeking to achieve. I mean, ultimately, everybody is going to want to be looking to maximise their returns, but fundamentally what you do with those returns will vary from person to person, and the tax rates that you're exposed to also varies from person to person. So, before I move on into talking a little bit more about tax, the three typical structures that you're likely to see property portfolios owned within are individual, and I'm going to include in there partnerships. So what I mean by that is you would own the property in your own name. Typically, you'll see your accidental landlords, so those who've perhaps inherited a property that was being let out, owner-occupiers, and also smaller landlords, so those with a smaller portfolio. Companies, which are also known as special purpose vehicles or SPVs, So that's held by a limited company. These tend to be a little bit more complicated setup because you've got to think about your share structure. You also have more onerous filing, and you are also subject to the Companies Act. So it's a little bit more complicated and comes with more regulation than if you own it as an individual. But typically we will see the larger portfolios and buy-to-let investors set up through that limited company structure. The third, and I'm not really going to touch on that too much this evening, are trusts. So that would be that the property is held within a trust, and typically you'll see these used more for estate planning and asset protection. Okay, so from a tax perspective, in the life cycle of having a property portfolio, there's 4 key areas that you're going to see. So on acquisition, you're going to be subject to SDLT, or highly likely to be subjected to SDLT. And because you are already landlords, or I assume most of you will be landlords in the room or thinking about becoming a landlord, you are going to be buying an additional property potentially to your main home. This means you're going to be looking at potentially higher rates of tax, but I'll come on to that a bit more in a second. You've then got during the ownership, so depending on your structure, dictates what kind of taxation you're going to pay. And that you will then be paying on an annual basis throughout the duration of your ownership. The third is disposal. So if you're thinking of exiting or liquidating your portfolio or selling your portfolio, then you're going to potentially trigger capital gains tax. That comes back down to, what's the difference between effectively what you either inherited a property at or you paid for the property in the first place, and then what it's worth today. So you're being taxed on that growth on the underlying value. Fourth is inheritance tax. So they say, unfortunately, there's nothing certain in life except death and taxes, and I get to mention both of those in one sentence, so that's great. Inheritance tax, and again, I'm sure there is much discussion around what is going to happen with inheritance tax potentially in the budget. But again, that's something that you would potentially need to consider in terms of planning for the future. So SDLT, I'll just go through this very quickly. Effectively, regardless of the structure that you own a property through, you will be subject to the same rates of SDLT. So from a consideration of how do I own this, the SDLT position doesn't vary. What does drive the SDLT values is what the value of the property is and what bracket that sits within, and also your residency status. So if you're a non-resident, then you will potentially be subject to a 2% surcharge over the base rates. I have a very quick slide. I'm not expecting everybody to take in all those rates, but you can easily find these online if you wish to. But the key message being that there's a surcharge if you're owning a second property. So you'll be at 5%, 7%, ranging up to 17%, which is higher than if it's your first property that you're purchasing. And as you can see on the end column, the non-residents are 2% higher. So taxes during ownership. So you will be receiving gross rental income, but against that you will be able to net off certain types of expenditure to get to a net profit or your net rental income. How that's taxed does depend on the structure that you're in. So for an individual, you'll be taxed at whatever your effective marginal rate is. So that's driven by what your other income sources are. And that would be between 20 to 45%. At present, there's no national insurance on rental income or rental profits. However, we may see that change in the next budget. That's something that's rumoured to be potentially under scrutiny. A company will be paying corporation tax. So if you're a small company, you might be paying at the 19% rate, but the main rate is actually 25%. So you'll be paying 25% tax on that. And I think an important consideration there is when you're comparing that 25% against the 45%, is that with a company, it very much depends what you're going to do with those net rental proceeds as to whether or not that is actually going to be the most effective way for you in the future. A trust will be taxed at the trust rates. I have got it on there just for illustration, but again, as I said, trusts are a bit more complicated because ultimately the tax would flow through to beneficiaries and what their effective marginal rates are. So I'm not going to get into that this evening because you would definitely need to take specialist advice around that. Now, the important point, and I'm sure you're probably already aware of this, is that from a mortgage perspective, if you own the properties as an individual, you are not able to claim the full rate of interest if you are a higher rate taxpayer. So the level of which you can claim interest is restricted to the 20% rate. That's been around for quite a few years now. And what we did see was a surge of people wanting to incorporate their portfolios so that they could effectively take advantage of the full deduction that you still get within a company. Now, it's not as simple as I'll take my property that I own personally and plonk it in a company and get the full deduction. But certainly, if you've got a heavily geared portfolio, it's one of those considerations you might need to look at. However, on the flip side, typically corporate lending rates tend to be higher than personal lending rates. Excuse me. So there's a lot to weigh up and consider when thinking about your structure. There's a second tax during ownership, which is the annualised tax on enveloped dwellings, which is known as ATED. Hopefully it wouldn't necessarily apply as a landlord because you should be able to take advantage of a rental exemption, which requires an annual submission. But it never applies to individuals. It only applies to companies because it's about, the reason it's talked about enveloped is because you've put a residential property inside a limited company. It only applies to high value properties, so that's properties valued over 500,000 as at April 2022, and you're required to have a valuation every 5 years. Again, don't really need to get into that because it shouldn't really come into play if you're an active landlord. You should be able to claim the exemption. The reporting of that individual follows the self-assessment deadline, so you have to pay your tax and file your tax return on the 31st of January, which is following the April that the income is generated in. For a company, it follows the company year end, so you could have a company year end of any month, and it would always be then that the tax is due 9 months and 1 day after that, the year end, although the actual tax return doesn't need filing for another 3 months potentially after that. Right, I have just a little example here just to show if you had a profit of 60,000, so a net profit, so that's after you've deducted your allowable expenses, what that tax position would look like. And as you can see, the personal ownership, if you're a higher rate taxpayer, is slightly lower than if you are a personal, you own the properties personally and you're in the higher income tax bracket. It goes up because once you're over 100k, you're losing your personal allowance, which puts you into a really high, between the 100 to 125k, you're in a really high effective tax rate. We call it the nasty place to be. It's either go through it or be below it. But being between it, it puts you into sort of what we call quite a painful place to be. When you compare it to the company, you can see that corporation tax rate looks really quite attractive compared to the personal options. However, I come back to, depends what your objectives are and what you're seeking to achieve. Because if you need that money out of the company because you need that to live on and it's part of the income that you use to sort of live day to day, then you're going to need to think about how you're extracting that income out on a regular basis. And at that point, you're then into like a second tax because you've got the corporation tax and then you have your income tax when you then take out those funds. And you can see that the combination of the company income plus the dividends, then it actually becomes more expensive than if you own it personally. Right, so the next one is, so if you were thinking, and hopefully you're not feeling this way this evening because you're seeing the way forward with all of this new legislation, but if you're sitting there thinking, actually, I feel the way forward might be to liquidate my portfolio, then you would be potentially looking at selling, and then you'd be into the world of looking at the CGT exposure. So if you're disposing of your property, as I think I mentioned before, you're calculating the difference between effectively what we call your base cost. So that could be, if you've inherited a property, that would be your probate value. If it's you've purchased it, then it will be your purchase value. But also it's at this stage, if you've purchased this and paid a load of SDLT, you'll actually get some tax relief here. Also important to note that if you've spent a lot of money on enhancement expenditure, so I've mentioned a few times about making sure that you're only claiming for allowable costs. One of the common errors that is made is the distinction between, say, what's a repair and what is actually capital spend. And so it's important to keep really good records so that you know what you've been spending on those properties when you've had those years where you've spent a lot of money, but actually it's capital expenditure, so you haven't received an income tax deduction. But when you come to sell it, this is when you get that benefit. And so it's really important to keep good records, because sometimes we see people going, oh, I know I did this, that and the other, and of course it was 20 years ago and they're not actually sure what it was. HMRC will allow some reasonable estimates, but it is far better, particularly under scrutiny, when you can produce specific invoices or receipts from the time. There's a possibility you may qualify for reliefs. If, for example, you've got a property that's in your portfolio now, but you had lived in it as your primary residence at some point, then it may be that you've got an apportionment of primary residence relief that you'll be able to use against that gain. That calculation can be a little bit complicated, so it's definitely something I would look to get some advice and support on. But again, it's a way of actually, hopefully saving some tax off of that gain. Okay, just have a little very high-level worked example. I didn't get into a full computation because I thought it might just be a bit too much on a Wednesday evening. So with the CGT, from a personal taxation perspective, at 24%. So again, I just used the same number. This time it's a gain of 60. So your personal tax rate, assuming you're a high rate taxpayer, would be at the 24%. The company pays corporation tax on a gain. So you still calculate the gain, but it's a corporation tax. Now the reason that you see a gap is, one, you've got a 1% tax differential, but also as an individual you get a £3,000 a year capital gains annual allowance. It used to be higher, but again, going back to my point at the outset, the government's got a gap to close, and so we're seeing some of these allowances and reliefs being squeezed out. At the end, again, this comes back to my point about it does depend on your long-term objectives. So whilst having things in a company allows you to retain year on year more of your profits, and that therefore gives you more to reinvest, if, however, you're actually needing to extract every year because this is a source of income that you need to live off, then again, you have to look at what's your overall effective tax rate once you then dividend out those retained profits. And you can see that combined effect, particularly when you're disposing, can be quite high. Now, I'll just throw in there, that is just assuming you're selling one property and then you would like to take out the funds. If you were fully liquidating the entire portfolio that's sat within a limited company, there may well be planning and tax treatment that allows you to avail of capital rates, so being able to go at the lower end. But that needs planning, discussion, and certain criteria to be met to achieve that. So inheritance tax applies to any estate. So on death, any estate that exceeds the nil rate band will be subject to 40% tax. Now, currently the nil rate band is at 325,000. The nil rate band has been frozen for a number of years, and there is much speculation that we're going to see continual freezing of rates, because what this achieves, without having to raise tax rates, is with the fiscal drag, i.e. people's incomes or properties all increase in value, people are naturally being dragged up the higher tax brackets. You might qualify also for a residence nil rate ban, so if you've got a main home in your estate and you're leaving it to direct descendants, then you may get an extra 175. Now, there is more complexity around how your bans work. The husbands and wives can transfer bans if they haven't utilised it on the first death. But I'm not going to get into the complexities because it is quite a complex area. And I think one of the key points I want to make is I think it's really important when thinking about your IHT planning that you seek advice. You'll find that the solicitors in the room will be able to help and advise you in terms of structuring your affairs, and we can obviously advise from a tax perspective. But one of the important things is if you've got properties inside a limited company, you won't qualify, unlikely to qualify for business property relief, because typically a landlord, unless you are really, really heavily actively managing the portfolio, won't meet the threshold of being a trade. It will be deemed to be effectively an investment business. So you don't unlikely to qualify for business property relief. The good thing about having a portfolio within a company is that you do have some IHT planning opportunities. So it is far easier to pass on segments of shares than passing on whole titles of properties. And it gives you the ability to potentially look at structuring the share ownership structure in a company. And so you can effectively have different ways of splitting out the capital rights and the income rights of the company. You can look at using things like gifting. Again, this is an area where potentially we are hearing that the government are thinking of looking at reviewing those rules. Currently, if you make a gift, then as long as you survive 7 years, then that will drop out of your estate from an IHT perspective. And we're seeing that they may change that to a 10-year rule, or again, the maximum you have to survive 7 years for it to fully succeed. But if you live for sort of 3 or 4 years, then you'll end up with a partial tapering up to the 7 years. But again, there is discussion over whether or not that whole tapering model may be reviewed. You have to be careful. You can't just gift things away and then say, but I'll retain the income, because that's something called a gift with reservation of benefit, or a GROB. So again, that fails, and we do see people who think they've given away something, but because they've retained an interest, actually on death, that asset falls back into the estate, and so there's a little bit of a nasty surprise when they think that something's not in the estate and it actually is. Historically, there was planning around offshore structures, but all of those kind of things have really been sort of clamped down on, so it's quite hard. The use of trusts and also structuring your debt can help mitigate your exposure, but the moral is, particularly around IHT, it's a complex area. You certainly need to sit down with a professional and get some advice around what you can do, because it will be completely bespoke depending on your circumstances. This slide, the point of this slide, I'm not going to try and talk it all through, I've talked about pretty much most of these things on here, is saying that there isn't a one-size-fits-all answer. It really does depend on what you're seeking to achieve. So, on one hand, you might have lower taxes in the company compared to income taxes, but, if you own things personally, you have no protection of your assets, whereas the company provides you with some protection. In terms of IHT, like I've mentioned, you've got much more flexibility if you were looking at some kind of trust. The company offers you sort of more like a medium level, but from an individual, you are quite limited. As you probably might expect, in terms of complexity and then things like fees, it tracks really with the, if you like, the benefits that you get from these different structures. So compliance matters. It really does matter. As I've mentioned at the outset, HMRC are actively recruiting, they are growing in power, and it's because they have got a manifesto to go out there and reclaim all of the taxes they feel have been underpaid. So, excellent record keeping is essential. Obviously, if you've got a really good letting agent, they will provide you with statements on a regular basis to help you track that, and they will help you in terms of managing the records of what you have. It's important to be able to defend HMRC investigations, but also, like I said, when you come to do things like a capital gains tax calculation, having those records is really important so that you don't lose out or don't pay too much tax on something that you could have claimed a relief against. I can't recommend digital records enough. I'm sure some of you in here will have already heard that Making Tax Digital for Landlords will be starting in 2026. So for those landlords who had gross income of greater than 50k in the last tax year, they will be mandated into MTD for next April. What that means is digital records will become essential, so you won't actually have a choice. But digital records do bring some benefits. It allows you to understand your figures. It means when you sit down with your professionals, you can have a sensible conversation and you can make decisions in real time with accurate data. One thing to be aware of, as I said, the changes with the interest allowable deductions from rental profits for mortgage interest, when that came into play, we saw a lot of schemes being pushed out by accountants and solicitors around property portfolio incorporation, and saying, you can avoid SDLT and you can defer CGT and blah, blah, blah. Those schemes are under huge scrutiny with HMRC. I'm not saying they never succeed, but there are very specific hallmarks in which to achieve the the savings that they promise to achieve those that you actually have to hit. And most landlords will not hit those thresholds. So proceed with caution if you're thinking about going into those things. And I certainly would encourage you to get additional advice. As I've mentioned, it is an evolving landscape. I think I mentioned at the outset, what you might set out and plan on one day might not still work in another few years. So it's important to constantly be reviewing your affairs. In terms of what we might see for the autumn budget, I think I've probably mentioned pretty much all of these as I've been going through. But as I said, the focus is around potentially taxing wealth and assets. So I've said freezing of tax bands. I've talked about potential national insurance on rental income, or the changes on the IHT gifting rules, and potentially reforming property taxes. These are all just suggestions. These are not things that I know about or have been formally put out there. But these are certainly things that are being mooted as things that we could see coming in the next budget. And finally, the last one being charging CGT on high value homes. So having a threshold as to what level of property qualifies for the full primary residence relief. So currently at the moment, the speculation might be on a property over 1.5 million. You may find that gains over the 1.5 million will be outside of the primary residence relief. But until we see that and we see it in legislation, I don't know. Okay, final thoughts. How easy is it to change structure? Well, you definitely can change your structure, but you really, really need to be aware of what the tax implications and the costs are to you. Undoubtedly, there would be professional fees also involved. You need to be really clear about what your short and long-term goals are going to be. As I've talked about, owning things individually works for the short-term investors, or where you need out the income to live. But if you're longer term, or you're heavily geared, or a high rate taxpayer, then certainly looking at a company can pay dividends. Forgive the pun. And then finally, like I said, you can look at some estate planning potentially if you're willing to sort of look into the trust route. But the key message is engage with your professionals early, because it is a constantly changing landscape. That's it for me, so I shall hand back over to Tom. Thank you very much.
Thank you. Thank you, Sophia. That was very, very insightful and really useful. Just a quick touch on what might be coming in the future. The main thing is a change to the minimum energy efficiency standards, or MEES. These currently exist. You'll all be aware of them. Your property must be at least an EPC band E to be let currently. There are exemptions. At the moment, they are looking to move that up to a band C. So quite a jump up, an E up to a band C. Now, the dates they're talking about are 2028 for any new tenancies and 2030 for all tenancies. Personally, I'm pretty sure these dates are going to slip, and it is a proposal, but the government are very much pushing to get properties up to an EPC band C for all letting properties. Now, currently you can always claim an exemption. So if the works are over £3,500 at the moment, you can claim an exemption and continue to let. They're taking that threshold from £3,500 up to £15,000. So quite a change there. So you might be able to claim an exemption now, but with that £15,000 worth of works, you would have to say that to move your property up, it would have to cost more than that, or spend up to that amount to be able to continue to let it, to get it up to a band C. EPCs currently last for 10 years. They're likely to shorten that period. They're talking anywhere between 2 and 7 years. They'll probably settle around 5. But don't be too concerned about this. James Goodman, who's here this evening, he runs a company called I'd Love to Live Here. He's an energy EPC assessor. He's our photographer standing at the back of the room. So if you have any EPC related questions, please speak to James. He looks after the majority of the EPCs that we instruct through the business. But what we've seen is that they have changed the way that they're measuring EPCs. James is probably had to put the costs up of the EPCs, but he's measuring every window aperture, for example. And the first few ones that we've had come back have actually been rated to a higher band. So don't panic. First step, get a new EPC done by the new measures, and see where you stand. And then just bear it in mind. This will come. I think the dates will slip, but it will come. And if you're buying another property, just look to buy one with a C or above. So I'd just like to say thank you all so much for coming. We very much valued you being here and enjoying this with us. We will be circulating a video of it and the slides. So there will be some canapes coming around if you would like to enjoy those, and the bar is open. So thank you all very much.